But you mentioned that you are looking for a 50 bips rate cut by May. So to your mind, what are the chances that Reserve Bank of India could surprise everyone by front-loading the interest rate cut?
With the, unfortunately strong consumer price inflation number moving up, towards 11%, and obviously with the headline WPI number disappointing somewhat, then I doubt they're going to do 50 at this meeting. I just hope they don't do nothing. That is also, of course, a risk. But my sense is that they will do 25, and perhaps not just on the repo rate, but on the cash reserve ratio as well. And I think what will dominate the thinking there is the weakness of growth. Obviously, that shocking December quarter number of 4.5% for GDP. The fall in core inflation that is ongoing. And of course the improvement in the public finances, and the government's the finance minister seemingly met his what seemed like extremely ambitious fiscal deficit target for 2012-13. That I think will go down well with the central bank, and as I say, I think 25 basis points is the most likely outcome.
So, Robert, do you think that the RBI may most likely be slightly hawkish as it remains concerned about the current account deficit, or do you think it will more likely shift its stance to support growth?
Well, we've seen already from various RBI statements that they are shifting towards a greater focus on growth. They've seen obviously inflationary pressures, particularly underlying inflationary pressures, coming off. They are, as a result of that, slightly more comfortable about the inflationary situation. So growth is more of a focus now, and growth has, unfortunately, disappointed significantly in recent times. To have said even 6 months ago, let alone a year ago, that the Indian economy would have been growing 4.5%. Would have been, nobody would have believed you. This has been a huge surprise, including to the central bank, and I think the central bank, does have to respond to that. As far as the current account is concerned, it is a problem, and of course it does make one worried about the future of the rupee, and the RBI again has referred to that. But my suspicion is again we're over the worst on that front. We did see finally a better trade deficit number for January, and the work I've done suggests that it takes a good 18 months or so for the weaker rupee to have an impact on the trade deficit. It is now about 18 months since the rupee started depreciating. I think it's going to drop, and I think that in turn will mean the trade deficit and the current account deficit narrows, and narrows probably somewhat more than generally expected. We're looking for a current account deficit of something in the order of 3.5% of GDP in the next fiscal year.
The fuel price inflation in the month of Feb, which led to higher, WPI inflation, do you think we've seen a complete pass-through of fuel price hike so far, and now the fuel price inflation will come down?
No, we'll certainly have more to come. Obviously, the partial liberalisation of the diesel price will mean that we'll get ongoing increases in diesel prices month after month, possibly well into 2014. So that hasn't finished. However, the overall impact of that on inflation is likely to be, about 1 percentage point in total. And I think from a central banking perspective, this shouldn't be seen as particularly bad news. It reflects, as I say, the removal of a subsidy which has distorted markets somewhat. Has contributed to the current account deterioration, and is something that the central bank itself has been asking for removal of the diesel price subsidy. So I can't see the RBI turning around and saying, look, we're not going to cut interest rates because of fairly strong fuel price inflation. That would seem pretty odd, as I say, in the context of what's been going on there.
So final question, what are your expectations on India's GDP for FY13 and FY14, and have you factored in a gradual recovery in the coming financial year or in the second half of this calendar year?
We certainly have been bringing down our forecasts fairly consistently over the course of the last 12 to 18 months, as everybody, of course. I think the March quarter GDP is probably not going to be particularly impressive again. The huge fiscal tightening that the finance minister has delivered during the second half of the fiscal year clearly impacted the December quarter number, and I think will impact the March quarter number as well, perhaps by even more than it did in December. But thereafter, I think we will get a recovery, and my sense is the recovery could be a little bit stronger than the general consensus. There are a few things out there which leave me relatively optimistic. I mean, first of all, although we haven't seen yet a huge amount from the RBI, we have seen declines in some money market interest rates, including one-year commercial paper rates, which are down something like 150 basis points over the last year or so. We've seen the government's reforms, which I think will boost consumer confidence. We've still, I think, as I say, got the full effects of that currency weakness to come through as well, and there's going to be much less, if any, in fiscal tightening in 2013-14 relative to that very significant squeeze we saw in the second half of 2012-13. So much less in the way of fiscal drag in the coming fiscal year.